A common misconception that many people have is that you can take all your RMDs from one tax-deferred account, but that's not necessarily true. In this video, I'm going to discuss the accounts that you can mix and those that you cannot. I'm also going to provide you with some key strategies to help you simplify and streamline your required minimum distributions. That's coming up, so stay tuned. Hi, I'm Gerald Harvey with Fedway Financial, and this is the Money Briefing. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. One of the biggest benefits of traditional IRAs and company-sponsored retirement plans is the ability to defer taxes for most, if not all, of your working years. But this benefit does not last forever. Starting at age 72 and every year thereafter, you must withdraw a specific amount of money from your tax-deferred and company-sponsored retirement accounts. This withdrawal mandate is referred to as required minimum distributions, or RMDs for short. There are a number of rules and stipulations that are associated with RMDs, and not following these rules correctly can potentially cause you to incur some harsh penalties and consequences. One of the rules that you want to be aware of when planning your RMDs is the aggregation rule, because this rule is sometimes misunderstood and wrongly applied. The RMD aggregation rule groups tax-deferred accounts into three different types. The first type is IRAs, and this group also includes SEP and simple IRAs. The second type is company plans, but it excludes the IRA-based plans that I just mentioned, as well as 403B plans. In fact, 403B plans stand alone as the third type in the aggregation grouping. So let's discuss how each one works. The IRA group includes all your traditional IRAs and rollover IRAs that you manage personally or with a financial advisor. It also includes SEP and simple IRAs, which are typically used by small businesses and self-employed individuals. The RMDs for each IRA account must be calculated separately, but the total RMD for all your IRA accounts may be taken from one account or from multiple IRA accounts. For example, let's say a person has a $8,000 RMD from a traditional IRA account, a $5,000 RMD from a rollover IRA, and a $2,000 RMD from a SEP IRA. The total RMD requirement for the year is $15,000. That total RMD amount can be taken from just one IRA account. It can come from two different IRA accounts, or it can be taken from each account separately. Additionally, SEP IRAs and simple IRAs do not have the still working exception like some company plans. So a person could be taking RMDs while at the same time making or receiving annual contributions. The second category under the aggregation rules is company plans. And this group may include 401k plans, profit sharing plans, thrift savings plans with the federal government, or 457 plans with a state or local government or nonprofit organization. The RMDs for each company plan must be calculated separately and they must be taken separately. Again, let's look at an example of how this works. So let's say a person has a $4,000 RMD from a 401k plan with a previous employer. This person also spent 25 years working in the federal government where they have a $17,000 RMD from their traditional TSP and a $6,000 RMD from their Roth TSP. The total RMD requirement is $27,000, and each RMD must be taken from each individual account. Some people may be puzzled by the RMD requirement for the Roth TSP, since contributions to that account are made with after-tax dollars, and there are no RMDs for Roth IRAs. However, Roth company plans like a Roth 401k or Roth TSP do have required minimum distributions. The good news is that these distributions are not taxable. However, if you miss taking RMDs from these Roth accounts, you will incur a 50% penalty on the amount that you did not take. Typically, if you're still working, you don't have to take an RMD from your company's traditional or Roth accounts until you retire or separate from the company. The last type is the 403B plans, which are sometimes called tax shelter annuities. These plans are typically provided by schools, churches, and hospitals. These RMDs for each 403B account must be calculated separately, but like IRA accounts, you can take an RMD from each 403b account or collectively from one account. Generally, you can also delay distributions if you're still employed with the organization. Additionally, I want to point out that RMDs may never be aggregated between different types of retirement accounts. So, in other words, if you have an RMD for a traditional IRA, a 401k plan, and a 403b, you cannot take one total distribution from your IRA account to satisfy the RMD from the other two accounts. This is a big no-no and can potentially lead to some major issues. Also, if you and a spouse both have RMDs, each of you must take distributions from your own individual accounts. One person cannot take all the RMDs from his or her account to satisfy the requirements for both people. Now, I want to provide you with 5 different strategies or solutions that can help simplify your RMDs. One thing you can do is consolidate all your pre-tax and tax-deferred retirement accounts into one traditional IRA. This is very helpful, especially if you are already retired. You can move your different IRA accounts and company plans into one account that can help you better manage and streamline your RMDs. If you're still working, another strategy is to consolidate and transfer all your old employer plans to your existing company plan. Transferring these older accounts into your current plan can help you delay taking RMDs on those other accounts until you retire. A third strategy that may be beneficial is transferring any company-sponsored Roth accounts to a new or existing Roth IRA account. If you do not already have a Roth IRA established, you may want to open one before retiring or soon after retirement to help avoid or eliminate the 5-year tax rule on your earnings. I also want to point out that RMDs do not have to be in cash. You can transfer shares of stocks or funds from your IRA to a taxable brokerage account to satisfy an RMD. This strategy is known as an in-kind transfer, and you should check with your account custodian or financial advisor about this type of transaction to determine whether it's available and appropriate for you. This strategy can be helpful if you don't want to lock in losses by selling positions in a down market. Even though the shares are not sold, you will owe taxes on the transferred amount to satisfy the RMD. One additional solution that you can do to streamline RMDs is set up automatic withdrawals for a specific date or specific intervals. Your RMDs can be paid out with one lump sum or installment payments, and any withdrawals that you take during a calendar year, whether it's intended for RMDs or not, will count towards your required minimum distribution. It's also important to remember that RMDs are taxed as ordinary income, and they can potentially bump you into higher marginal tax rates. You have until December 31st of each year to satisfy your RMD. However, if you're taking RMD for the first time, you may delay withdrawing the RMD until April 1st of the year after you turn 72. If you miss the RMD deadline or take RMDs from the wrong account, you may incur a 50% penalty on the amount that's not properly taken. For example, if you were supposed to take a $15,000 RMD, but only took $10,000, you'll owe $2,500 penalty plus income tax on the shortfall. But if you or someone else makes a mistake in distributing your RMD, the IRS is relatively lenient in waiving the penalty. You can request relief by completing Part 9 of Form 5329 and file it with the IRS, along with a letter of explanation, including the action you took to fix the mistake. Knowing the RMD aggregation rules and understanding where and how you can take your RMDs is important in helping you to properly plan for your retirement distributions. If you received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. Additionally, if you have any comments or questions about required minimum distributions or retirement planning, you can add them in the comment section below, or you can email us at ask@fedwayfinancial.com. Thanks for watching, and we'll see you on the next Money Briefing.